Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. With so many recent interview guests on this channel expressing concern about the near record levels of overvaluation and narrow trading breadth in stocks, and about slowing economic growth, a weakening consumer, and rising recession risk, many of you viewers have been asking for an instructional video on how to protect your portfolios from market downside risk, a process otherwise known as hedging. Well, your ask is our command. So in this video, the senior partners at New Harbor Financial, one of the financial advisory firms endorsed by Thoughtful Money, will walk us through the fundamentals of hedging using options. John Llodra and Mike Preston, along with their team at New Harbor, employ these options hedging strategies on a daily basis to protect the $500 million in client capital that their firm manages. John and Mike, thanks so much for being willing to give us this important primer on risk management.
Thank you, Adam. We're really glad to be here. We get asked quite often to do some kind of hedging or options webinar or video. That's what we're going to attempt to do today. John and I have been in this business for about 25 years, and for all of that time, we've been using hedging techniques, mostly with options. And so we are experts in the field. Now, there's thousands or maybe hundreds of thousands of ways to use options. We're going to show you the most basic ways today, and we use mostly the basic methods in our daily management. We do the more conservative things generally to try to reduce risk. Options can also be used to increase risk. And so we want the viewer to understand that. So with that, I guess I'll also introduce John, give him a moment to say hello, and then we'll start the presentation.
Hello, Adam, and hello, everybody. Thank you for giving us this platform, Adam. It is something that we're passionate about. We have built a career becoming skilled in the use of these tools, and we appreciate it. Mike and I are both engineers by training. There is a certain amount of math aptitude that options require to fully understand and fully use smartly. They're not complex if you know how to use them, and we certainly use them, as Mike has mentioned, in conservative ways that we think add value to client portfolios and can help smooth out the ride in otherwise very volatile market. So we have a slide deck pulled together. We're going to try to bring it to life through our comments and examples, but we appreciate this platform. So I'll start sharing screen. Mike's going to kick us off here. Is that okay with you, Mike?
Sounds great. Let's do it. And while John is bringing that up, bear in mind that this is going to be a hedging class 101. This is a beginner's class, not an exhaustive discussion by any means, but we hope it kind of gets you started. And by all means, reach out to us if you want to talk about this. The standard disclosures here are on the screen. There's risks involved in all options. Please go ahead and read this. And there's a disclosure document that's also available. If you'd like, we can offer it to you. But our objectives is basically to give you some basic information here. Okay, like I said, this is options 101. This is not exhaustive. You could spend a whole lifetime studying options. In fact, John and I have done so thus far, and there's still a lot probably that we don't know. But we are very skilled and expert in the options and the way that we use them for hedging. So we'll go to the next slide. I'll go over some of the basics, and I'll be talking about some fundamental definitions here in the beginning. So options are contracts. The first thing you need to know about options is they're contracts. They are created and destroyed by the Options Clearing Corporation, the OCC. And there are exchanges like the CBOE, the Chicago Board Options Exchange, where these things are traded. But they're contracts, and each contract specifies a certain number of shares. In general, 100 shares of the underlying stock or instrument. You can either buy or sell these contracts. That's the neat thing about them. In general, people are accustomed to the idea of buying a contract or buying a stock. But with options, you can actually sell them. You can sell them without owning them first. So it's very easy to short contracts, and there's a lot of good reasons to do that, which we'll chat about a little bit later. One more thing on this slide I'd like to mention, premiums. A contract essentially is an obligation or a right, depending upon which side of the trade you're on, to purchase or sell a security, and there's a price. Normally, there's what's called a strike price with that contract. So that strike price defines when you can act, whether you're a seller of that underlying security or a buyer of that underlying security. So remember, an option is a contract. It has a strike price at which it's valid or or exercisable, and it has an expiration date. Very importantly, with options, they all have expiration dates. So they are depreciating assets. Now, that's really good if you're a seller, which we often are, and there's special strategies that can be used to take advantage of time decay of options. It's a very, very powerful powerful concept. If you can get the time decay of options on your side, you could flip the equation. Normally, people that buy options are option buyers. Normally is how people use options. And 80 to 85% of the time, options contracts expire worthless. That's part of the reason why they have a bad rap. But if you're a seller and you can get time decay on your side, you can really shift statistically the odds of winning to your side. And we can explain that in a little bit more. There's two option contracts type. A call option simply is the right to buy a security. A put option is the right to sell a security. It's as simple as that. And I don't think I'll go too much more into detail other than if you're buying the option, in either case, you have the right to either buy or sell a security. If you're selling short that contract, which we often do, you've got the obligation to do so. So that's the difference. If you buy the contract, you have the right to exercise. If you sell the contract and you're short it and it expires in the money, you have that obligation. You don't have the choice. So key parameters of option contracts, things to look at in an option chain. And I think that perhaps I'll pull up an option chain here to take a look at. So I'm going to pull up an option chain here for, let's just use Apple. It's a very common one that's often used. I'm going to go ahead and share the screen. So here's an option contract for Apple. The stock is trading at $213 per share. If I pull up a daily chart on Apple, you can see it's had a nice move here for quite a while, trading at around 213, moving to a weekly chart. You can see we've moved from about 170 to 213. So Apple's a very, very popular stock. It's one of the big three, and it's got a very deep and liquid options chain. So here is a tool called ThinkPipes, similar to Thinkorswim that a lot of viewers may be using. If you don't have this, you may be using Yahoo Finance or something like that. So all of these dates here are options expiration contract dates. Hopefully you can see these on your screen. It starts at June 28th, and it basically goes every week for the first month or two. Then it goes monthly or even quarterly, all the way out to December of 26. I'm going to pick one here, maybe 3 months out. September of 2024. This is September 20th of 2004. Standard option contracts always expire on the third Friday of the month. So September 20th of 24 is the third Friday of the month. Those are standard contracts. There's non-standard contracts, but I'm going to stick with standard ones in my illustration. Over here is the days to expiration. Most time decay of options happens in the final 90 days. So if you're going to sell options, which is what I'm going to show you right here, or at least show an example of it, you want to stay within 90 days in general, because that's where you're going to get most decay, most of the time decay, and that's going to work on your side if you're a seller of that particular contract. So in the September contract, let's just take a look at it here. The stock is at $213. If you look at these prices here, these are the strike prices. Let's look at one that's just out of the money. The September 2024 $215 contract. On the left-hand side are the call options. These are the right to buy. On the right-hand side, it's probably small. You can see these are the put sides, and these are the right to sell, call and put. If we go down to September 20th, 215, you can see that the call option here to buy, the right to buy Apple at 215 is $9.65. And the put side is pretty close to that, about $8.50. There's a slight difference because of dividends, but both of them are about $9. And essentially, this is the market saying that it expects movement over the following 3 months to be around twice $9, or about $18. If you add these two together, Apple would be expected to move, based on the model, the BlackScholes model, about $18. But And then we can either sell or buy, we can either look at the call side or the put side. Just a quick example, and then I'll take a pause because I feel like this gets a little bit complicated. If you owned Apple, you could sell a call option out in September at $2.15 for about $9 per share. And this means that if Apple stays below $2.15, you keep that $9 a share in your pocket. If Apple goes above $2.15, you still keep that $9 a share, but you have to sell. You've got the obligation to sell Apple out in September at $2.15. So $2.15 plus 9 is $2.24. That means that your maximum upside would be up here around $2.24. So I feel like that's pretty complicated. So I'll take a pause here and go back to the presentation. But this is your basic options chain. That's what we want to show. And you could pick any one of these and you can do either side, call or put, and you can buy them or sell them. And beyond that, I think it would take probably a one-on-one discussion, which we're happy to do with you individually.
Mike, just before you head off of that screen, again, the key parameters to think about an option are the expiration dates, the strike prices, and the underlying security that you're looking at options on. And that option chain, you can, as Mike pointed out, there's plenty of expiration dates. You can go out really long dated. Some securities like Apple, you can go out as far as December of 2026, right? It's 905 days. Not all securities will have option chains that go out that far, but then there's the various strike prices. And I'll get into in a moment here, what for many people is a mystery of how options are priced. It's actually a pretty simple concept of how they're priced if you're not familiar with it, but it seems like a mystery. And I'll get in and hopefully simplify that here in a moment. So I'll take over sharing here, Mike. We'll go back to the presentation. And that was a great intro. So let's get a little bit into the math. And this is going to be simple math, I promise. I got some pictures to illustrate. So coming back to the presentation. So first of all, options have been traded on things for millennia, or certainly centuries. I'm quite sure if you go back to the silk trade or the spice trade back many centuries ago, there were transactions that resembled option type transactions where basically parties traded contractual agreements. They could have been verbal, or they could have been written on slate or something like that. But the concept has been around for centuries. But some groundbreaking work was done in the early 70s by three gentlemen: Fisher Black, Robert Merton, and Myron Scholes. And this resulted in what is now known as the BlackScholes Model or formula. And that was in 1973. And basically, this basic model serves as the basic analytical construct for how options are valued or how they're priced. Here's the formula. I'm not going to go into, you can see it's a pretty wonky formula. I kind of studied this kind of stuff in college, so it's kind of like English language to me. But basically, there's a couple of key variables. There's the strike price, the time to maturity, and the risk-free rate. Okay, as well as the call option price, or the kind of the value. The risk-free rate is things like interest rates, treasury rates. That factors into how these things are priced. A key thing here is the volatility, and we'll talk about that. The more volatile an underlying security is, the more rich the option will be valued. And why is that? Because in simple terms, I'm going to highlight right here. Options are priced based upon the calculated probability. It's all about probabilities. How probable is it that a given option contract will end up what we call in the money, and meaning that it has value to the buyer of that option come expiration, and by how much it will be in the money. Otherwise, if it's not in the money, the option will be worthless to a buyer. So the value is really an assessment of the probability. That's really what's at the heart of this Black-Scholes model. This is a picture that kind of hopefully will convey this. So let's start in the upper left here. This is right here, is this vertical line is intended to reflect the current price of a given stock. Okay, this red curve, bell curve, is meant to reflect a pretty typical standard, what we call normal distribution bell curve. In reality, I'm going to get a little wonky here. Options are priced, they don't follow a standard normal distribution. In fact, they have more of what you might call a log normal type of distribution, where essentially this bell curve is kind of skewed to the right. Moreover, because of in practice, you have these tail events, These tails of this distribution in practice are what we call fat. They end up having higher probabilities here than what a standard bell curve would conjure up. But for the sake of this example, we're going to use a standard bell curve. So here you have the current price, and there's a certain probability. The height of this red line is the measured probability of a price move higher than the current price or lower than the current price. And the further we come from the current price, the lower the probability. It's pretty logical. An extreme move has less and less probability the more it moves away from the current price. Okay, so that's what that's represented. So an at-the-money call option where the strike price is set at the current price, the value for that is simply this value here, the probability that the stock price goes higher between now and expiration, because every move higher is by definition going to be some value for the option because the strike price is at the current price. So it's really the cumulative probability here measured by this green. That's what works into the prices of the options. Lower left here is an example of an out-of-the-money call option where the strike price is higher than the current price of the stock. So as you can see, the stock has to move quite a bit before it ends up in the money. And the cumulative probability, the area of this green area, is smaller than that. And that's why an out-of-the-money option commands less premium. It's a cheaper option because the probability of it ending up in the money is that much less. Contrast that with an in-the-money call option where the strike price, this vertical dotted line, is below the current market price. That's what we call an in-the-money. And the value for that is most rich of all because this area is greatest. And furthermore, the area here that's below the current price is what we call intrinsic value. It's the amount that the stock is currently in the money. Okay, and we won't get into an exhaustive talk about that, but hopefully this paints a picture. There's not a mystery to what prices are. They are precisely the market's calculated or perceived probability for that particular option to end up valuable to the buyer come expiration. And of course, like any market, there's differences of opinion. Sellers obviously think it's a good value to sell. Buyers think it's a good value to buy. And that's where markets are made, by differences of opinion there. This next chart shows basically the value of a call option. I'm going to look at just call options, not put options, at expiration. So again, here's an example of a strike price, okay? And it could be $100, $50, whatever. It doesn't much matter. What matters here is what happens to the stock price between the time of the option initiation and expiration. This is a value at expiration. So if the price goes higher above the strike price, well, that's going to start to mean the option value is going to be positive because every dollar the strike ends up in the money below the current market price is a dollar that is of value to the buyer of that option. But if the price drops and it drops below the option strike price, it's going to have zero value to the buyer of that option. That's why you get this kind of inflection point and 45-degree angle here. Okay, let's start this is at expiration, importantly. This is at expiration of the date of the contract. Let's start to look at this concept that we call time value, because this is a really important point. This basically overlays what that profile of a value of an option would look like. So we have the same green line here, that's at expiration. But as you go further and further out from expiration, there's an incremental value, the difference between the green line and the blue line, for example. This is a hypothetical option value at 90 days till expiration. This difference is what we call time value. Now notice, an option at expiration where the price is below the strike price has zero value. But an option that has 90 days to expiration, for example, still has value because there's a good probability that the price could very well jump above that strike price and suddenly be in the money. But what you see here is as expiration days kind of tick down and you get closer to expiration, the difference, the delta between these colored lines and the green line are thinner. And in fact, if we looked at 1 day to expiration, this red line would be barely perceptibly higher than this green line. Couple key takeaways: the further in or out of the money an option is, the less time value. Okay, but also at right around the strike prices where at the money options where the greatest amount of time value is. And that's a very important point to understand, especially if you're a buyer versus a seller. We touched upon it earlier. It's kind of an exhaustive discussion in and of itself, but that's basically the gist. So let's go right into some options, some examples of option hedging strategies. Mike talked about in the option chain of Apple a potential scenario where you sell call options, sell short. Now, importantly, when we sell options short, we're not short, net short. We're doing what's called a covered call option, where you sell a call option against the underlying shares that you own. That is what's called a covered call option. So there is no short exposure. There is no unbounded risk here. In fact, if I could describe in layperson's terms what I'm going to stop sharing for a moment here, what a covered call strategy might be expressed as what the purpose is. It's a great strategy for someone who wants to be in a certain investment, wants to be long or invested in a certain asset market, stock or whatever, but they want some degree of buffer. They want some degree of downside protection. And they are willing to give away some upside beyond a certain price level to get that buffer. And this is especially the case. This is great for folks who are bullish on a stock or moderately bullish, but think there's some limit to how high it could go. And selling a call option with a strike price at that limit is essentially saying, I don't think it's going to go higher than that anyways. I might as well get paid for that belief. And that premium I get paid for selling that option ends up being some downside buffer and maybe an extra dividend or whatever you want to look at it. So I'm going to share again my screen and look at a graph of what this looks like. All right, so here's just an example. This is a hypothetical ticker XYZ, and the price of this stock is 377. I've got some quotes here, hypothetical quotes for call options that are at the money, right at the current strike price, and this happens to be $20 a share. 5% out of the money, 11. Now, of course, because it's out of the money, it's going to be cheaper. There's less probability the stock's going to be above that strike price come expiration. And 10% out of the money, even further out of money, and therefore even a lower price because of less probability. And here we go. In a $409 strike, very far out of the money is well, 409 is somewhere between 5 and 10. And then there's some put option strikes. So let's jump ahead here to the example of a covered call. So if one were to just buy a stock outright, and let's say the purchase price is this dotted line, $377 a share. The profit on this stock is going to be based upon, and actually this chart got a little distorted. At that inflection point, it would be 0% return. If the price moves higher, the value of the stock or the gain on the stock would go dollar for dollar higher. Same in the case of a price decrease, the price would start to lose. The stock would start to lose. So you get whatever the market goes up or the stock goes up, but you also lose whatever the stock goes down. Let's go to a different example here. And again, I apologize. Some of these charts got distorted. This dotted line should be back where this inflection point is. Basically, what this blue, so the red line is if you just own the stock outright. What the blue line shows is if you sold an at the money call option, you would cap your appreciation above at that level, but you'd be paid a premium, so you pocket that premium, that becomes return. But in a downside scenario, you're better off because you've buffered to some degree the downside, and that's expressed by this difference between the blue and red line. Okay, and this is obviously for illustration purposes only, it's hypothetical. But it's, in a nutshell, options give you the ability to electively shift the risk and reward profile for any given investment. And you have literally a whole range of things you can do. So for example, if you sold a 10% out of the money option, you have more upside, but your downside protection, the difference between the gray and the red line, is less than the blue and the red line. So you're trading off upside versus downside protection. Okay. Mike's going to go in and talk about another strategy, which is known as a protective put. And of course, that uses put options, not a call options. So I'll stop sharing for a moment here, Mike, and then we'll get into the chart when you're ready.
Thanks, John. I'd like to talk about the example that we have in the presentation, but I think I might also like to talk about a real-world example that we have in the portfolio. Protective put options. When you're buying puts, and a put contract, by the way, is a right to sell, it can be looked at as insurance. It's the easiest way to look at it. And one way of hedging, and there's many ways as we're talking about in this video, whether you're selling calls or buying puts, which is what I'm talking about right now. Buying puts is buying insurance on your portfolio. And so, whether you pay out of pocket for that, like you pay premium for homeowners or car insurance, or whether you sell other options to pay for that insurance, essentially buying puts is buying insurance. You can also sell puts. I'm not sure we're going to get much into that in this presentation. That's kind of an advanced strategy. It requires special things like margin agreements. That's advanced. If you want to talk about that, please give us a call. I'll be happy to do a one-on-one with you and even do a screen share to show you some examples. So, John, I'd like to briefly just take a look at buying a put option on the S&P, which we have in our model. I'm going to bring back think pipes to show that. Then we can go to the presentation and go through the hypothetical. I'll try to keep it brief. So let me go ahead and share the screen once more. So here, when it comes up, you're going to be able to see the S&P 500. Now, the S&P 500 is actually a ticker symbol SPX. So let me start there. SPX is the S&P 500, which has been in a nice big uptrend. We currently have put options down at 4950, 4950. Now, the reason for that is because that was the recent swing low. Now, to buy options on the S&P is pretty difficult. Here is the options chain. And the reason why it's difficult is because the S&P options are basically denominated for $100 per point. So with the S&P at 5465, you'd be looking at $546,500 worth of stock just for one contract. That's too much for most people. So the CBOE, Chicago Board Options Exchange, came up with this, XSP. And so as you can see, it's a little bit of a play on the symbols. It just reversed the X and the S, and you've got XSP, and it's basically the same thing, but it's 1/10 the size. So the cool thing about this being 1/10 the size, and still most options contracts are $100 per point, which this one is still $100 at this level is $54,660. And so this is what we use in our model. And what we're doing here is we basically want to come up with a level that gives us a floor. And so if you have, let me just give you an example. If you have if you have a $100,000 portfolio, let's just use that because it's a nice round number, and you wanted to hedge it. And let's say you were 100% in stocks, and those stocks, furthermore, were relatively diversified in the market so that the S&P 500 represented a good hedge. You could say, you know what, if we go below this recent low here, which is 4950, and that happens to be around 10% below, I want to have protection in my account. And so to do so, you would want to buy 495 put options on the XSP. And let's go over to that. So a $100,000 portfolio, and seeing that each contract is about $54,000, you would have to buy 2 contracts to fully hedge that portfolio. And so let me just show you the options chain. Let's say you wanted to go to the end of the year, and the end of the year would be roughly down here. They've got September up. They don't have year-end options for this year yet. So let's just take a look at, let's see, actually, maybe I'm missing it here. Yeah, here we go. December, they do. I was just missing it. So the December 31st options have 188 days left in them. Let's take a look and see what those 495 put options cost to buy. So we're looking at the option chain again. We go to the December 31st options. Let's go to 495. And let's click on the ask price. This is what you would have to pay. And then let's buy 2. So it costs $1,200. I don't know if you could see that, but $1,218 to buy 2 of those things. And so I can say to you right now, for $1,200 on a $100,000 portfolio, that's about 1.2%, you can buy a put option that expires on the last day of the year. And if the market crashes, we can say with full certainty that you're protected at 495 and below. Now, the only issue about this is that this is your deductible. So if the market crashes, you're still paying the difference between the current price and 495. So on a $100,000 portfolio of about 10% drop, your portfolio is going to drop to 90,000. But for darn certain won't drop below there if S&P SPX is a good hedge on your portfolio. So for some people that are 100% invested, that say, you know what, I don't want to get out of my positions, this is a good alternative. So because for about 1.2%, and I could show some other examples going well into next year, you can stay long all of your favorite stocks and not worry about it at all, and just go ahead and buy put options. So there's a perfect example of how we use them in the portfolio. We are actually moving these floors up over time. We've done it over time, and happy to have a conversation with you about your portfolio. We could do something similar at a time where valuations are absurd and we think that we're facing crash risk. It's not a bad strategy. We have about a 10 to 15% position nominally in this. So that means if the market crashes, it'll take 10 to 15% of our clients' accounts right out of the stock market if we get a crash through 495. So I'm going to stop on this example, John, and ask you to start the presentation, which I will go through another hypothetical example quickly. So the lines on here aren't really that important. Basically, what it shows you, or what you want to know, is that if you buy the stock by itself, which is the orange line, then you have a pretty well-defined situation. If the stock goes up 10%, you're going to make 10%. If the stock drops 10%, you're going to lose 10%. If you buy an at-the-money put option, which is this blue line, your losses are going to be relatively limited. And I know it's kind of hard to understand with all the lines on this chart, but let's just say this: you're going to have roughly, X% downside. Let's call it, I can't tell exactly what it is here. It looks like it's about, the downside is going to be limit. You're going to have to pay the premium of the put, and I apologize.
It's about 5%, Mike, on the chart if we were to eyeball it.
It's 5%. Okay, so you're going to pay the first 5% deductible, like I was just showing in the previous example. But after that, you see that flat line? That means you can't lose any more. That's the nice thing about puts. But but also on the upside, if the stock works out in your favor, you're going to have to overcome that 5% to start making money. That's probably the simplest way I can put it. If you buy a stock and then you buy an at-the-money put and pay 5% of the value of that stock, you've got no losses below a 5% drop, and you've got no gains until you overcome that 5% premium. And then from there, your gains are infinite. They're unlimited. And so that's the cool thing about it. Now, the bad thing about puts, remember what we said earlier about time decay. The most certain thing in life, in investment life, is time decay of options. And professionals sell premium usually because of that 80 to 85% number that I said earlier about contracts expiring worthless. In this case, we're actually saying pay premium. Now, we're not contradicting ourselves. We're saying, okay, sometimes it makes sense to pay for the insurance. This is one of those times in a hyper overvalued market, you might very well want to just pay for that insurance. So maybe we'll go to the next slide, John.
I'll just make a corrective for those that are real shrewd and have caught this. This vertical dash line, the current price of the stock should be right here where that inflection point is. When this graphic was reformatted for the slide deck, it got a little kind of distorted. But the other thing I would point out here is this Mike referred to essentially a trade-off between deductible and protection, much like you do with health insurance or car insurance. If you want to bear more risk, you get a cheaper premium on your policy and vice versa. This shows this. I mean, if you want to bear more risk in this 10% out of the money put option, this orange line, as compared to the blue line, you're paying much less for that. That's why the difference between the red line and the orange line is very slight as compared to the difference between the red line and the blue line. That's because the blue line, the more robust insurance, costs more premium, costs more money.
All right. So we'll go on to a more advanced strategy here. Now, I know that we're focusing on options today, and that's probably our favorite way to hedge. I think maybe we were remiss to say that another way to hedge is to simply sell your stocks. We didn't say that in the beginning, and I want to point that out here. You could sell some or all of your stocks, put the money in T-bills, and heck, you don't need to hedge. But for those that want to stay long or have a complicated situation or legacy positions or part of a more complex portfolio like one that we're managing, Can't think of a better way to do it than with options. Now, did you want to go ahead and launch the presentation there, John?
Yeah, sure. For the caller here.
Yeah, so there's an example, and I guess I'll chat about the caller here. Basically, with a caller, you're combining two strategies. And with this strategy, it's kind of a complicated thing, I know, with the chart. It's hard to understand in such a short presentation. But we just talked about selling a call, and which caps your upside beyond the ceiling or the strike price of that call. And then I just talked about buying a put option, which caps your losses below the put option strike. You can combine these two strategies. And we do this a lot for people with legacy stock. Some people might come in with Apple or Microsoft stock that they've had for 10 or 20 years, and they're extremely highly appreciated stock. What we can do is take a call option above. I showed an example earlier with Apple. Sell a call option above the present price of that stock. And let's say you get $5 a share. And then you might take a look and see what kind of puts can I buy for that. And then you can come up with essentially a costless caller. And I think, John, I might just share ThinkPipes again really quickly to show a quick example. It's probably a lot better than just about any other way. Let's take a look at, this happens to be NVIDIA. Let's take a look at Microsoft. We'll do a quick example on Microsoft. Say that you had highly appreciated Microsoft stock. It's trading at 450. It's highly appreciated. If I were to show you the monthly chart, which I will here, you can see that this thing is up tens of times, hundreds of times if you go back far enough. So we talk to a lot of people that have appreciated positions. And I submit that we're pretty deep into this blow-off phase of this bull market. It might have a little bit more to go, but I would start by picking some kind of ceiling that's above the current price. So we're at 452. So let's put a line, let's put a ceiling in it around 460. And I'm going to put a line right there to denote that. So, and then furthermore, let's go out 90 days. I don't want to think about this between now and September, or you might say December or January to try to get that stock into the new year to avoid capital gains taxes. But for now, I'm going to keep it to about 90 days. So if I look at the September 460 call, it is about $17.50. Now, this means since we're putting that ceiling in there, we're selling that call option, meaning the buyer can buy stock from you at 460. They are willing to pay $17 a share. Now, I'm going to use that $17 instead of letting it accrete to the account and be like a special dividend or income to the account. I'm going to go ahead and spend it immediately. So I'm going to sell that 460. Then I'm going to look to the put side and say, what can I buy for 460? Or I'm sorry, this is $17. What can I buy for $17? Interestingly, I can buy 15s. This is a pretty good example of skew. So on the 470, I'm sorry, 460, it was just 17. It's $15. I'm sorry, here it is, $17 at 460. I'm going to sell that here. And then I'm going to take that $17 and see what I can buy. Well, I can buy 450s. This is a pretty tight collar, actually. But if you take a look at this, it shows a slight credit. So going back to this other side here, if I put a line at 450, and this might actually be a little tight, may want to do something wider. And Microsoft may have a dividend coming right up, and that could be why there's such skew to this. But in this example, out in the next 90 days, I'm selling a call at 460. I'm establishing a ceiling. I'm using that money to buy a put. I've got almost a perfect protection to the downside. And this is, again, these things can be widened out. Maybe we want to go up to 470 and down to 430, something like that. But hopefully that gives you some kind of quick example of what a costless caller would look like. The concept that we want you to get is that we're putting a ceiling in the stock. We're taking that money from the ceiling and we're using it to buy the floor. So we can go back to the presentation, John.
Yeah, I think the next part here, Mike, is we're going to talk about just some of the summary here. Basically, as we've talked about, hopefully gave a couple of just simple examples. Options can be used to really accomplish a range of risk management tools, and you can select how much risk versus reward you want to take or what makes sense. And want to impress, and I'm going to share the screen here just so there's some words here you can read as well. We want to impress that there is no free lunch, not in life, certainly not in option strategies. In the case of selling call options, you don't pay anything for those. You get paid for selling those. But what is the cost? The cost is you electively give up some upside. Okay. If you buy puts, the cost is you pay for that insurance premium, just like you do for your house or health or auto. Now, in most of those kinds of situations, you're glad that you didn't need the insurance and paid the premium and maybe wasted the money because it gave you the peace of mind to be in that asset that you couldn't, withstand a adverse event in. And as Mike already talked about, the cheapest form of hedging might just simply be to reduce one's exposure to the underlying stock or asset class. If you're overexposed, the cheapest form of hedging is to just sell some. Obviously, you want to take into account tax situation, things like that. I like to use the analogy of here in New England, we at least used to get some pretty big nor'easter snowstorms. We haven't had many in the last couple of years, but you can have a nice car and a gold-plated insurance policy where you don't have to worry about getting dinged because you're going to get protected by the insurance policy. But sometimes it just makes sense to keep that car in the garage. Don't take it out in the snowstorm. That's akin to just not playing, taking some chips off the table, selling some of that stock. So we really want to make that point clear. There are some pitfalls that we want to talk about, and of course, this is where it takes some skill and expertise to be able to do this thoughtfully and systematically. Basically selling options too close to the money. Foregoing more upside than you really want to or need to. Buying put options too far out of the money. If you're going to buy insurance, at least if you have an impulse to need some insurance, make sure it's there to protect you when you need it to. If you set the insurance too far out of the money and you suffer the deductible in getting to that strike price, it may be more than you're really willing to suffer. And then expiration dates. Basically, you want to make sure you have some time to let the option strategy play out. And that is going to differ if you're a buyer or a seller. Like buying a put option, maybe sometimes it makes sense to go out further because you're using it for a protective strategy. Selling call options, as a seller, you want time value to kind of waste away because you benefit as a seller when time value wastes away. I wanted to kind of just talk briefly about, there's been a proliferation of off-the-shelf products out there that use option strategies, and not all of them are created equal. And there's a lot of nuance there. For example, people, and this is not a recommendation, but there's a large covered call fund out there, JP Morgan, I think Income Fund or something like that. It's JEPY, J-E-P-Y is the ticker symbol. Now, many of these funds just systematically sell call options no matter what. And it maybe it's certainly an effective way to use that strategy, but sometimes having restraint in selling call options is really important. You don't want to sell call options, for example, when you expect a sharp move higher in the market or a stock. And I wanted to share an example to put a little bit to life the selectivity of where being selective and having a dynamic tactical strategy can make sense. So I'm going to share a chart of a stock here that many people might be familiar with. It's called Supermicrocomputer. It's one of the AI meme stocks, and this is a daily chart. And you see the stock has been pretty volatile. What I have here are these lines, this red line and this fuchsia line, are what are called Bollinger Bands. It's basically measuring plus or minus 2 standard deviations above moving average. And you see it's very rare for this stock to poke above its upper Bollinger Band. That is historically been, in this stock, and in many cases, a time where the probability of a further move higher is somewhat muted, and there's a very good probability of a pullback. Those are perfect environments to think about selling call options because the likelihood, it's not guaranteed, but the likelihood is that it's going to snap back and you get to keep that full option premium and your stock. And that, at the very least, that serves as a downside buffer to this, in this case, a very sharp move down in the stock. But even if the stock just pauses there, that call option can be an added form of return. So I guess the point I'd like to make here is just, it's really important to, you can do a very mechanical option strategy that just mechanically and mindlessly sells or buys options of various types. But we think the real value is when you can use it very tactically in the context of the day-to-day and week-to-week moves of the underlying security that you're looking to hedge or create upside in. I think that probably covers most of the prepared comments that we wanted to touch upon. We could spend a week giving a master class in this, and maybe we will sometime, but not anytime soon. But Adam, we just want to thank you again for providing this platform to us, and certainly folks that are watching here. Please feel to reach out to us. I know Adam will tell you how to reach us. But Adam, as the ear is on this presentation, if you have any questions for us that you think might be of popular interest for us to try to answer in the few minutes we have left, please fire away.
All right, I will do. And again, gentlemen, thank you for the presentation, the time it put to put it all together. So first question for folks watching, did you find this of value? And if you did, would you like to see more videos like this on other topics, just practical, fundamental, how to understand different instruments that are out there or how to affect different strategies in investing? If so, let us know in the comments below this video. We'll read them all. And if there's enough interest, we'll do more of these and other topics. So I guess first question I have for you guys is, this was super useful. I'm going to guess for some people, they were at least roughly familiar with some of these strategies, covered calls, protected puts, collars, etc. But hopefully you help them understand it even better. I think for a lot of people, this has been very helpful in helping them wrap their brains around something they really didn't understand beforehand. And in the world of options, my advice is you don't want to go out there and just start trading them on your own and basically stumbling into every pitfall along the way in the school of hard knocks and learning these things. You really want to start off by being under the wing of somebody who has a lot of experience in this, who can show you the ropes, who can help you avoid most of the beginner's mistakes. So guys at New Harbor, if you feel differently on that, let me know. But my question for you guys is if it may be difficult for people, even if they understand kind of the mechanics of a covered call or a protected put or a collar, if they're trying to figure out which is the best to apply to their portfolio, given their goals or the fears they're trying to protect against. If you haven't really done this before, it can be really hard to determine, well, which one is better for me. Is that a decision that you can kind of take people's hand and walk them through?
Absolutely, Adam. And we have several cases, many cases, in fact, that I can think of that we're doing exactly that. A typical case will be somebody that has a very concentrated portfolio. Maybe they worked for a company, one of the tech companies, have got a piece of stock that's very highly appreciated. Or maybe they just have an investment portfolio in some of the FANG stocks that are very highly appreciated. They know in their gut that they were probably close to a peak here, peak euphoria, yet they're looking at very large capital gains. So those types of cases are very, very good for us. We can do a lot of good in those cases, and we can work together to create a plan to put collars around some of those or all of those positions so that we can gracefully exit them over months to years instead of just blowing them all out here and having a large capital gain. And we don't know that the market won't go higher. In fact, I think it probably will in the near term. And with those collars that I just showed an example of, if 3 months from now we're higher in the stock, we can move that collar up, increase the ceiling, increase the floor, do it again and again and again. At some point, the market will tank and we'll take out those positions at the floor, hopefully at prices higher than where we are today. And hopefully we didn't have to pay to have that insurance in place all that time. That's what a collar can do. Happy to talk to anybody about that.
Yeah, and Adam, one of the great benefits I think that we can talk clients through is people become fearful when they don't understand what's at stake, right? We can illustrate for them with precision, how much risk they bear and how much, what it will cost to shift that risk, right? So we can kind of work through some scenarios. Where is their pain point and where is their comfort point? We can kind of work with them to look at a range of scenarios there to custom tailor for them. I did realize, and before we run out of time, we did have a slide that hopefully will give folks the quick skinny on how to reach us if they'd like to. Of course, Adam, you'll talk about how they can reach us through Thoughtful Money as an endorsed advisor. But here's our full contact info. We very much like to educate, and welcome folks reaching out to us, and we'd be happy to have an exploratory conversation as relates to your questions and your situation.
All right, great. Yeah, just in wrapping up here, so there's some other elements of options that you obviously didn't get to, just given the time that we had and given your main focus, which is really safety and risk management. But there are other ways to use options that are a bit more speculative. The transactions that you showed are all covered or protected positions. Now you can trade options in a way that's referred to as trading them naked. There's some real upsides there, but there's some real downsides and dangers. We don't really have time to get into them, but there's certainly that whole world of options that could be discussed. There are some other hedging techniques that can be used, like setting stops, setting limit orders, etc. Again, weren't in the scope of today's discussion. But if there's enough interest, and folks, if there is, let us know again in the comment section below. Guys, if there's enough interest to get into that and talk about some more advanced option strategies, is that something, or short hedging strategies, is that something you guys would be willing to do?
Absolutely. And one point we want to make, Adam, is we are very careful to set up client accounts with only certain levels of option permissions. We're very careful of when we enter option trades, but in the rare event we hit a button that we didn't, we make sure client accounts aren't even enabled to use those risky strategies. So we have many levels of protection, most of which is our own care and diligence. But we're very careful to make sure that only the most sensible and conservative ways to use options are allowed in client accounts.
All right. Well, gentlemen, thanks very much. We're at the end of the time here. Folks, if you enjoyed this, again, would like to see more videos like this, please let us know by, again, in the comment section, but also by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. And yes, the best way to get a hold of the guys at New Harbor to ask about these strategies or really anything else is to go to thoughtfulmoney.com, fill out the short form there. And if you definitely want to talk to the guys at New Harbor, there's a little menu at the bottom of the form that says, do you already know which advisor you want to talk to? You can just select New Harbor from that. Otherwise, the form will match you with the best advisor, given all the other information that you've entered there. Gentlemen, can't thank you enough for this. I do hope there's enough interest in doing more of these. I personally tend to think these things are highly useful. Otherwise, we'll see you guys here on the channel next week.
Thank you, Adam, and thanks for hosting. We really appreciate it, and thanks everybody for watching. We're here to help and look forward to it.
Thank you, Adam. It's been fun. We enjoy talking about this stuff, and it's certainly I think we think a value add for folks, and appreciate you having us on.
Awesome, great. Everybody else, thanks so much for watching.